you've got a question, throw your hand up. I'm happy to answer questions as we go. My name's Dean Croak. I'm a market analyst at DAT. I've been there about 5 years. Then I spent 5 years prior to that building the sonar platform at Freightwaves, and then worked for a whole bunch of companies like Qualcomm and Spirion on the trailer tracking side. But I'm a lifetime trucker, done a few million miles as an over-the-road driver, mostly in Australia. Family still has a cattle road train business. G'day, Adam. Good to see you, man. Yeah. So I'm still actively involved in trucking. I've got a show truck out here in the front row. Happy if you want to come out and see me afterwards. I'm in the front row. It's the only black Peterbilt with DAT on the side, so you can't miss it. But I'm more than happy to talk to you about trucking. But since I got out of trucking in the late 90s, I lost 2 drivers on my watch. Both died. And I had to go to the spouse and kids and deliver the tragic news. And of course, that's a life-changing experience. If you've been in trucking, you've ever had to do that, that's like the hardest thing you'll ever have to do in your life. And I decided to get out of it. And the transformation was ended up talking at a conference. I met a Harvard professor who said, would you come to America and run my consulting business? Been here 25 years. So that's sort of the transformation. But what I've done in the 25 years is worked with trucking companies and drivers to try and figure out better ways to do things, like better ways to be safer, how to make more money, how to manage cash flow better. Most of it, though, has been on the safety side and the sleep science side, keeping drivers how to sleep. We built some really cool stuff at Omnitrax where we could take the ELD data feed from the ECM and put it into a computer model and figure out how much sleep you're likely to get and how tired you were. And it was highly predictive data. We could actually stack rank all the drivers in a fleet and figure out which schedules had the highest level of probability of a single vehicle wreck based on historical data. You might say that's nuts and you can't do it. It is incredibly accurate to build data and predict things. So data is sort of at the centre of this. No matter what you're doing in trucking, data is absolutely the thing you've got to be the most diligent with, particularly when managing cash flow. I'm going to talk about that at the end, because that's not my specialty, although DAT has a very cool factoring product called Outgo that helps manage cash. That's just one component of managing cash. But I do want to talk about the freight market and why it's probably never been more important to manage cash flow with diesel prices where they are today. And I'll do some modelling. I've got my laptop here, so I can do some modelling with you on what the impact of the diesel price rise that's up about 29% since the Middle East war started. It's up about $1.30 a gallon, national average at Pilot, which is the largest seller of OTR diesel, over-the-road diesel in the country. So I can do some modelling and tell you what the impact of that is on spot market carriers in particular. So we can do that sort of live on the screen. But let me give you a summary of where we think the spot market's at. Just to set the scene, DAT is, you would know DAT, Dial a Truck, as the load board company. That's how you would historically know it. That's how we started, the name Dial a Truck. Some of you would remember the monitors in truck stops and the ding that would go off. And well, it's turned into a big company that's now an app on a phone, and you can search for loads, factor loads, book loads. There's all sorts of wonderful things you can do. But the company, from a revenue perspective, we see about 150 billion in freight spend. It's a lot of loads, right? 150 billion. 50 of that is contract freight, 100 billion is spot, right? So predominantly spot. Contract is mostly large retail shippers, which is predetermined rates that are agreed in advance. Spot market, the other 100 billion is spot market rates determined the day of or thereabouts. So what I'm going to focus mostly on today is where is the spot market at, because that's a leading indicator of where we think the market's headed. Normally it's sort of the pointy end of the stick where there's the most efficiency, you've got the most companies coming in and leaving, it's the most impacted by rate volatility, and it's absolutely the most impacted by the recent rise in diesel prices, because the spot market rate doesn't carve out the fuel surcharge. It's a truckload rate, it's a rate, and you've got to really know your costs to figure out if you've been getting the fuel surcharge. And what we've found, and I'll show you some data, we've found that spot market carriers have at best been getting 50% of the fuel surcharge in the last couple of weeks. So you've been really getting hammered at the pump, and it's squeezing them very hard. And so for 3 weeks, we've seen spot market carriers really hemorrhaging. They're just starting to get a little bit more of the fuel surcharge coming back, because from a broker to a carrier, the fuel surcharge doesn't get passed through completely. It's not a full pass-through, and that hasn't been happening. On the spot market, only half of that fuel surcharge of 68 cents a mile was being passed through to carriers. And that's why line haul rates were dropping in the last few weeks. So if you run trucks and you felt like you've been squeezed in the spot market, there's a really good reason why. But I think we're past to the worst of it, because it takes time for us to catch up, us being owner-operators. All right, where's the market at? Market conditions. I just read this morning that ATA contract volumes are up 2.6% month over month and 2.3% year over year. Bob Costello said that volumes surged. He put it down to capacity exiting, which is an interesting statement after fairly flat demand. I can give you copies of these if you want. You don't have to take pictures. I'll give you copies. Just give me your email address and I'll send it to you. So there's nothing here that we wouldn't share every Monday on my show that I do or in a newsletter. So demand in terms of, loads on trucks, demand to haul stuff. Now remember, I'm talking about the freight market. I'm not talking about sand and gravel and gasoline, right? I'm talking about freight of all kinds, which is, over 250 miles. It's not dump trucks hauling sand around or salt around Boston, right? That's not what this is. This is freight of all kinds, which is long distance, mostly over 250 miles. So all the rates I'll talk about are for loads over 250 miles. Under 250 miles, you get too much accessorials, you get round trip rates, you get a lot of noise in the data, whereas our rates that we're talking about today are one-way loads over 250 miles, to give you a sense where the long-haul freight market is, but volumes are still very soft. Most of the tonnage indices that we look at in terms of how much tonnes the industry uses or hauls is kind of what we call it cycle lows. We're kind of at a low point. I'll say this, I hope it doesn't get any worse. My best expectation for 2026 is that demand doesn't fall. If it stays flat, we'll be okay. But if it drops, then we've got another bigger problem, because demand has been dropping faster than carriers have been exiting, right? Which is what's kept the lid on rates, right? We're only just starting now to see capacity exit the market. All of these shady operations have exited to a point where it's starting to lift rates because there's fewer trucks than loads. We're at the cycle low bottom. Now we're not at the low because we've got more demand to haul more loads. We're at the low because there's fewer trucks for the same demand. Right, so it's important to remember demand is flat, but fewer trucks means that there's less trucks to haul that freight, and that pushes up rates for everybody. We're at that point. And I haven't been able to say that for years, like literally 3 years. I haven't been able to say that we're at that point because none of us really knew. But because this was an elongated freight recession that was spanned multiple years, it forced a lot of carriers out of the industry, a lot of marginal operators that paid too much for their equipment. Demand was sort of dropping. We had a trade war last year that kind of put the brakes on a lot of manufacturing data. And we still had too many trucks in the market from the pandemic. Remember, during the pandemic, we had double the number of carriers join the market from when PPP loans ended in July of 2020 to today. Right? And we're still seeing some of that capacity hang over in the industry. So eventually we'll get to a point where there'll be the right amount of trucks for loads, but we're kind of there, and I'll show you some data that tells us that we might be there in terms of rates going up. Because the way you measure are there too many trucks on the road is what are rates doing, which direction are rates going. And I'm going to talk national averages. I'm not talking regional or Atlanta to Phoenix, right? I could, but I won't. I'm talking national average rates to give you a sense of which direction is the market heading, up or down or sideways. And I'll show you some data to sort of support that. So hopefully at the end you'll get a sense of where this market's at here as we sit in March of 2026. So demand is flat. This year there'll be a gradual but uneven recovery. Capacity removal will do most of the heavy lifting. So if you're a regional carrier, I think it's going to be a pretty good market. But if you look at national indicators, you're not going to hear any headlines that say the market has flipped. There was a lot of BS going on in the last few months about how spot rates have taken off, tender rejections are going really high, and the market has flipped. No, that wasn't the case, right? We're not seeing demand move in a way that you can say that that's the case. But we might get there shortly, but I'm not sure we're there yet. So capacity's exiting. That's been a big topic, hasn't it? Non-domicile CDL, ELD, English proficiency, a lot of it's been overblown. The numbers have been inflated, right? None of that's going to make, a massive difference, but it is making some difference, especially on backhaul lanes. So there's individual lanes where we're seeing very tight capacity. But we are at a point where it feels like there's sufficient capacity has exited the market now. That's starting to mean that we're closer to the number of loads equals the number of trucks. Because for the last 3 years, we've had way too many trucks for the number of loads. Because both were heading down, and the number of trucks leaving couldn't catch up to where the loads were, right, if you think about that visually. So we didn't see demand lifting, but we saw capacity sort of exiting the market slowly because people were going out of the business, but people were actually being forced out of the business in the last few. I'll show you a chart that sort of supports where we're at there. Rates are firming. There's a new floor under spot rates this year because rates are about 25% higher than where they were last March. So why is that if demand is flat? If we've got no more demand to haul freight, why are rates up? Well, there's fewer trucks. So that's the good news. For the first time in 3 years, we've actually got higher rates year over year. And what was interesting is we had 3 bad storms after Thanksgiving. You remember you all got caught in it, right? And that snarled the network. Rates skyrocketed. Normally they fall off in January. They didn't. They stayed elevated because there were fewer trucks around this time. And then they've stayed elevated ever since. And we're about to hit spring, building, construction, planting, nursery seasons, and there'll be a push of volume into the market, and we're going to hit spring with rates about 20% higher than where they were last year. So that's great news in terms of where we are in the cycle. Contract versus spot. Contract rates have been much higher by about 40 to 50 cents a mile for the last 3 years. So that means contract loads that large shippers send to large carriers, they've been getting a better rate, and spot rates have been much lower. But they get the gap, if you looked at them online, they're closing. Spot rates are almost the same as where contract rates are nationally. So what does that mean? Well, if you start to get spot rates higher than contract, do you know what happens in the market? Do you know what large carriers do? Carriers in general will say, we'll go and haul in the spot market and reject those contract loads. Now, we haven't seen that for a long time. Right? And normally spot rates lead contract by 4 to 6 months. There's kind of a lag. So if you think where spot rates are going, at some point in 4 to 6 months, contract rates catch up. They start to go up also. So we're at this inversion point where spot rates are rising almost as much as the contract market. Remember, the contract market's 80% of the loads being moved. Spot market's about 20% of the loads being moved, right? But that 20% is kind of the leading indicator of where the market's at. Diesel, the numbers here, I've got 561. Now, I sent this in last week. It's 551 this morning. It's up 127. It's up 28%. But fleet margins have still been compressed by about 70%, and I'll talk about some charts there. For the first time in a long time, Adam, I'm going to ask you this question. Have you ever seen a supply-driven change in the market in your history? Never. Yeah. Yeah, so that's Adam Wingfield, by the way. You need to talk to him if you need to know anything about how to run a truck business. What's been fascinating is we've had this narrative in the industry from all the industry experts that have said the only thing that ever changes the market is demand. It's always a demand-driven event that flips the market. Well, that's not happening now because demand is flat. People are worried about the trade war, they're worried about the Middle East war, they're worried about economy, consumer economy, they're worried about layoffs. There's a lot of concern in the market. For the first time in Adam's history and in my history here, this market change has been driven by supply, not demand, which means supply is trucks and drivers. There's fewer of them now. And that's starting to drive the next market cycle. It's the first time we've seen this. It's a really weird phenomenon. The general consensus is the freight market is still cold on volume. We're not seeing anything on the horizon that would say there is going to be a material change in the demand for loads on the back of your truck. There's nothing there. Domestic manufacturing tonnage, steel tonnage, single-family housing, interest rates are still high. We're not building enough single-family homes, right? There's 5 to 6 flatbed loads every single-family home. Those numbers are down about 12% year over year. So we're not seeing a lot of indicators out there that would say that we're going to see a lot more tonnage in the market. right? So capacity exiting is going to be the story that we'll focus on. All right, first chart I want to show you, and I'll show you a couple of flavours of where we think capacity is at, but this is the chart there's a bit of noise in this, and there's always a lag with FMCSA data. But this is the number of carriers that come and go in the industry, and the black line is just the difference between the adds and the subtractions. So the green are carriers that activate an authority each month. They're for hire authority. And the red are the carriers that revoke their authority. Say, I'm done, I'm going to go and haul a trailer for Werner or Amazon, or I'm getting out of the industry. They revoke their authority. So what you see there is a chart that shows you that the pandemic era there in the middle, we're July 2020, and we saw this doubling of the number of carriers. I'm not joking, the number of for-hire carrier authorities issued by the FMCSA doubled, and some. And that's that black peak there. And then you can see that we've been a gradual decline of carriers leaving the industry down on the bottom there. What's interesting, I just looked at the numbers this morning. We're at the 27th of March, thereabouts, and we've already lost 6,000 carriers this month. That's about 100 more than we lost for all of last month. Now, last month was a 28-day month, right? But we're on par to see a higher number of carriers exiting this month, which I think is interesting. The green line at the top shows that there's even fewer carriers joining. And that's been a downward trend since last April. April was a multi-year high. That's that green bar at the high part there and just to the right of the chart. That's that April high we had last year. There was a massive influx of carriers. But it's down 32% since then, and it's still trending down this month. So good news, fewer carriers coming in, more carriers going out. It's a good example of capacity starting to tighten. We've got fewer trucks out there. I drove my truck down from Boston last week, and I noticed it was observable how quiet the roads were and how few trucks there were in truck stops. Have you guys noticed that? Like, it's always seemed to be pretty easy to find a park now, like a parking spot. I don't know, maybe it's just me, but there definitely is fewer trucks on the road. I think it's something, there's something going on with that. All right, so if you look at the red, you can see that we've been losing capacity, but we haven't been losing it at a faster rate than people have been joining. That black line is still hovering around the centre, right? So you can't say there's been a fundamental shift in the market in terms of for-hire capacity. So this data here, just to be clear, this is everything over £10,000 GVW, because the FMCSA doesn't break out data by class of truck. But we know from the DAT numbers that 9 out of 10 of these carriers end up on DAT's load board. So we know they are 5-axle tractor trailers hauling spot market freight when they come in. So we know who these folks are, right? And most of them have got less than 10 trucks. Vast majority are owner-operators. So this tells you kind of one view of where the industry's at. The next view is, hang on, I'll have to come back to that one. So this is now the cumulative number of trucks going year by year or month by month. And you can see the growth rate there in the early part of 2016-27, we were growing at about 3 to 5% per annum. We're always adding trucks to the market because the economy was growing. 2019, it fell back to about 2% because that was a freight recession. We got to the pandemic and you can see that volumes grew by 55%, adding 124,000 new carriers to the market. Hot shots, box trucks, straight trucks, 18-wheelers. There was like, you name it, came into the industry. The one sector that's stuck is hot shots with the 40-foot RGN. That is one sector that has stuck in this industry since the pandemic. It's a really interesting trend. And you can see that the number of total carriers has now dropped back down to where it would have been had we not had the pandemic in terms of normal growth rate. So we're getting back to sort of normal levels of growth rate for the for-hire market, which I think is manageable. Because that mountain that we saw there ruined a lot of businesses. It also made some businesses because they did pretty well out of it. Now let me just check what I've got here. All right. So what does that mean? Well, I want to put this into some context. This is a computer model or an Excel spreadsheet model that I run that tracks the operating costs and DAT dry van rates and what the gross profit margin is. How much money are we making? Are we winning or losing? And this is based on, so remember DAT's DAT1 app, when carriers log in to our app, they put in their operating costs into the app and it tells them is the load profitable or not. So we've got a lot of data that comes in that tells everyone, that tells us what their operating costs are. I have a database of operating costs that I've built up over the years, plus I'm still buying fuel and filters and insurance. I still know what it costs to run a truck. So this model, right, and remember these are averages, This is based on 100,000 loaded miles and 15,000 empty. And it's a dry van running in the spot market. Fairly efficient, running fairly hard. And I'll explain the numbers to you, but on the far right, that truck at $5.51 a gallon for diesel, $10,000 a year for insurance, $3,500 for lease costs. It's a pretty average, middle-of-the-road cost to run a truck. It's 60 grand in wages, so it's break even. I don't know, Adam's going to jump on me and say that's not what it costs to run a truck because that doesn't include profit. Am I right? I remember that's a conference you did. You said it's like, if it's 212, it should be 260 or something like that. And you're dead right, because this doesn't include profit. This doesn't include the 10 grand you need for a blown turbo or a 35 grand in-frame rebuild. It doesn't include that. This is what do you need to get by, right, to pay your bills. So if it's 212 on the far right, the green line, it was $1.63 back in 2018, right? So costs have gone up. The red line is the gross profit and the blue line is the DAT dry van rate per mile. So on the far left is 2018. Remember 2018 was a pretty good year for all of us? The gross profit per mile back then netted carriers the equivalent of $34,000 a year gross profit. That's what 2018 looked like as an average. It was a really good freight market for the first 7 months. It was mostly a flatbed freight rate rally. It was a very strong flatbed market, very strong industrial economy. So we made about 34 grand, the equivalent of. That's what would have been. 2018 led into 2019 where we had record numbers of trucks and we had excess capacity, and then we went into a freight recession because of the trade war and a few other things. Rates started to slide south. We ended up losing about 2 grand. So we went from making 34 to losing 2. And then the pandemic hit, and that turned to about $110,000 a year equivalent gross profit. Like money was falling from the sky during the pandemic. And that was the catalyst for a lot of people joining the industry with very little business acumen, because you'd had to be stupid not to make money during the pandemic. I only know of one large company that didn't. And I won't tell you who, but you can figure it out. So 34, lost 2, made 100, and then Russia invaded the Ukraine in 2022 and the market collapsed. Rates fell, diesel went up to $5.81 in June of 2022, and we're only about 20 cents a mile off it right now. So we had a record high diesel in June of 2022, but that diesel price surge and rates dropping caused the market to slide, and that red gross profit line went right back down close to zero, where we've been at break even for about 3 years, barely getting by. Most companies are not generating a profit to pay for the blown turbo or the in-frame rebuild or all of that. You know, that $10,000 cash reserve you need that everybody recommends you have as sort of that rainy day fund, that's not included in that. So for the last 3 years, it's been a real struggle on the bottom line there where that red line is. And then we got to December and spot rates took off. And then we saw the market take off, and carriers, the profit margin jumped to about 20 cents a mile in December. So finally the market started to turn where we were making money. December, January and into February. And then the war hit in the end of February, and that wiped out that $20,000 a year, just like that. So this is the tough part of this, because we were just finally making headway, and then diesel prices skyrocketed about 27%. They're up $1.31 a gallon since $2.27 when the war started. And now so December, January, February, we were making about 20 grand equivalent of a year. In 3 weeks, that's been wiped out. We're back to break even. In fact, worse if you're not getting the fuel recapture. And I'll do some modelling for you to help explain why managing cash flow is such a big deal. This is based on all-in rates of $2.49. So the all-in dry van rate today is $2.49. That includes the fuel surcharge of 68 cents a mile. Right? That's how the math works out. I can tell you what the line haul is. So if I take out, so the all-in rate's $2.49. If you're not getting a fuel surcharge and your broker's giving you zero, the rate would be $1.90. That's the line haul rate. It'd be $1.90. Now, as an industry, you're getting somewhere between $1.90 and $2.49 as spot market carriers. Now, our data shows that over the last 3 weeks, you've been getting about 50% of that. So you've only been getting about 34 cents a mile of the 68 cents a mile fuel surcharge that large carriers are charging shippers. It's not a pass-through from the broker to you. The broker says to the shipper, we need 68 cents a mile for fuel. That's the fuel surcharge based on the EIA national average diesel price published on Tuesday. We want 68 cents a mile. And then they go to you to move the load, and they negotiate a load rate. And if you don't know your costs, right down to the penny, and you've got to be somewhere and you take that load, what we've found over the last 3 weeks is spot market dry van carriers have been lucky to get 34 cents of the 68 cents fuel surcharge because line haul rates have been dropping. And you would think, how is it possible if diesel's gone up so much that line haul rates are dropping and all-in rates are going up? It happened in 2022. It happens every time there's a surge in diesel prices. So let me show you how the math works out, because it takes time for carriers to catch up to where the market is. It takes us time to find our footing and negotiate from a stronger position and say, we can't run for X dollars a mile with fuel where it is. We need more money, right? So it's all about negotiation. But let me do some modelling and show you that at $2.49 and diesel at $5.41, operating costs at $2.12, you're making 6 cents a mile. So you're making $6,000 a year. All right, so to put that in context, we're 2018, 34,000, lost 2 in 2019, made 100 during the pandemic, and then we've been down at break-even zero for about 3 years. We got to December, weather hit, spot market took off, we were making 20, right? And now it's back to zero. So if you feel like you've been on a roller coaster ride, that's exactly what it's been like. It's been very hard to budget our expenses accurately because of the volatility in the market. So we're back down to zero. So with fuel at $5.51 on this truck, right? So this is a theoretical truck. No one's running at these rates or prices. It's an average, right? Fuel's at 40%. It's 85 cents a mile is what fuel's costing you to run that truck. Now, if you've got a fuel card, like our DAT1 fuel card, you'd be running for $2.05. So you'd be taking off about 7 or 8 cents a mile. So you'd be making $18,000 a year at rates. So if all-in rates at $2.49, diesel at $5.51, less than 50 cents a gallon, I'll say DAT, but fuel card discount, whoever your program's with, you'd be making about $18,000, right? Now that's all-in rates of $2.49. Now I'm going to change the model to only 50% of the fuel surcharge. I'm going to bring the rates back down to $2.15, which is where most of you have been at for the last few weeks. So with a fuel card, I'm making $12,000, right? If I change this to $2.15 on the rate, I'm losing 24 cents a mile. I'm losing $24,000 a year. So if you haven't been getting the whole fuel surcharge, you're in the hole for the last 3 weeks. The cash flow crunch is acute because the rate of cash burn is way below break even. Now, so that's without a fuel card. With a fuel card, you're still losing 11 cents a mile. So at current line haul rates, if you're getting $2.15 a mile as an average and diesel at $5.51, less fuel at $5.05, if that's what you're buying fuel for, that's the equivalent of losing about $11,000 a year, which is worse than the freight recession in 2019. It'd be the worst we've had in many, many, many years. So like this is a dire situation if you're not getting the full fuel surcharge recovery. Like that's absolutely critical that you get most of the fuel surcharge if you're running this truck. So that comes down to negotiation and working with your brokers and your carriers and your shippers and all of that stuff. Any questions on that? I'm only talking averages, right? But just to give you a sense of the impact of what fuel's done to us in the last little while, because we were seeing some headway, Chris.
You mentioned that the demand is flat.
Yep.
But we all know that if the fuel stays up,
yep,
the demand will drop. People will stop buying stuff.
That's the problem.
So how much time do we have before the market collapses? How long does the fuel price have to stay up before we see the demand drop?
It's a tough question to answer.
Has this ever happened in the history?
No. So we don't have precedents for this. But what I would say is that if capacity still exits, at some point we've got far fewer trucks than even flat demand, and that starts to drive rates up, and that saves us.
But if the capacity
drops
and demand...
Yep, so there's a lot of what-ifs here. I think if diesel got back to where it was during the summer of 2022 at $5.81, we're in trouble, where rates are. Like that's not a good place for us to be. So managing cash and slowing down, like 75 to 65 miles an hour is like giving yourself a 5 cent per mile pay rise, 5 cent per mile rate rise. 10 miles an hour will put another $5,000 in your pocket each year. It's 5 cents per mile on the rate, just from slowing to 75 to 65. When you all drove here, how many people were hammering at 75 and 80 in trucks? I don't know if you noticed it, but people weren't slowing down. Well, they're not paying for the fuel, so it's burnt. So anyway, slowing down is probably the most important thing you could do there. All right, so that's sort of the context of where we're at with operating costs. We're back down to where we were for the last 3 or 4 years. We need diesel to drop. It's been sitting at about $5.45 to $5.50 for the last week. I mean, every time there's a surge in crude prices, the rack price goes up and the retail prices goes up. It feels like we've kind of hit a ceiling with all of the craziness that's going on in the Middle East and all the stuff that's coming out of Washington and Iran. It feels like we're at a ceiling of where the market's pricing in all of the possible risk. That's what it feels like, because it hasn't gone higher than 551 so far as a national average, right, at the retail level, OTR. All right. Talked about that. So where are rates? So this is now a couple of charts, and I publish this every Monday on my DATIQ show on YouTube at 11 a.m. You must watch, do you? Thank you. And if you want a copy of my weekly long-form newsletter where I provide these charts and this commentary, give me your email address and I'll put you on the list. It's all for free. You don't have to be a DAT customer to get it. So the red line is dry van line haul rates. So these are line haul now with fuel taken out. Because when you're looking at rates, you really want to strip out fuel to see what's the underlying rate per mile doing to haul the load, not what fuel's adding. Right? Because fuel 3 weeks ago was 44 cents a mile, now it's 68. And some people look at that and say, oh, rates are going up. Well, no, diesel went up, but you're not getting all of the diesel costs passed through to you. So you're not winning. You've got to know where the market's heading and what direction, you've got to look at line haul rates, which is ex-fuel. Doesn't include the fuel surcharge. So the red line, you can see it came down in the January, and we got to about the 3rd week of February, and then Winter Storm Fern hit. Then the market took off. And then the market's been sliding south, and you can see that steep drop and that V shape. That's the last 3 weeks, where rates dropped as all-in rates went up, diesel went up, and your inability as a group, I don't mean that as a negative thing, but as a group, we were unable to negotiate the full cost of diesel increase into the rate, the load rate, on the broker to carrier spot buy. So what that meant was line haul rates were dropping, which confounded the market because it made no sense. If diesel's going up, why are rates dropping? Well, it's because of margin expansion on the broker side. They were keeping more of the fuel surcharge and paying you less. That's how free markets work in this case, right? But we got to Monday, so diesel dropped for 2 weeks, 2.5, 3 weeks. It flattened out last Friday. It was flat, no change, and it started to go up this week. So what's that tell me? Tell me is that carriers are now starting to get higher percentages of the full fuel surcharge. Not all of it, but they're getting a big chunk of it, which is great news because line haul rates are going up, which is that V on the far right, that red line. So the blue line, the blue shaded area is last year's rates, and the green is the last 5 years, excluding 2021 and 2022, which in data world are outliers. They were the pandemic years. So I've taken them out because they distort your view of the world. So we are currently at about 18% higher than last year and about 17% higher, or 32 cents a mile higher than the 5-year average. So you would say, that's great, right? And that's the cushion. That's the cushion that's allowed us to survive $5.51 a gallon. You mightn't feel like it. I know you want to throw brickbats at me for saying that, but that's been the cushion that hasn't forced the mass exodus out of the industry. It's not good, but it's only because rates are higher that we've been able to absorb and keep going for a little while. We can't afford rates to drop or diesel to go higher, right? So we're still not out of the woods yet, but that's dry van. So where we are in the market cycle, who's timekeeper here? How am I going on time? 1:49. Okay, so I've got 11 minutes. Okay. So market cycles, where are we in the market cycle? You hear a lot of headlines about the market's turned, we're on there's a whole new world and everything's great. Well, remember I've just said demand is fairly flat, has been fairly flat. We're not seeing more demand for loads on trucks. Here's the last, this is 2011 on the far left. Now how you read the chart is, the red line is the rate per mile excluding fuel. That's the line haul rate excluding fuel. You can see the seasonality. The bars are the year-over-year percentage change. It's what was the rate on the red line compared to the year prior. Right? So you can see 2010-11, you can see the 2014-15 freight boom, then you can see the 2016 freight recession, and then we came into the 2017 strong industrial economy. Remember the Cat 5 hurricanes in the south in September of 2017 led into changes in the tax code, oil price rally, some other things tweaked the economy, and we're off to the races in 2018. Come September, everybody ordered a record number of new trucks that flooded the market. Trade war hit in May of 2018 with China, demand tanked. Too many trucks, not enough loads. We had a 2019 freight recession, which is minus 21% year over year, rates dropped. Just follow the red line and you can see the seasonality and the cycles in the market. Then look at the pandemic. Rates went through the roof. They were up as high as 68% year over year, and then they dropped during the last 3 years as low as 35% year over year. But if you look to the far right, you can see for the last 12 months, they were bouncing around zero, not a lot of change compared to last year. But in the last 3 months, you can see we are much higher than where we were last year. Now, you can't look at that and say this year's stronger because you're comparing to a weak period of time last year, right? But there is something changing in the market where rates are going up and they are better than last year. And we are in the early signs of another freight cycle, another inflationary cycle. Because you can see how the markets go like this. There's that rolling cycle to the freight markets in terms of rates. We are looking at possibly another upward freight trend. Chris, if capacity keeps exiting at the rate it is because of government enforcement, and we keep getting rid of these carriers that shouldn't be in the industry, and demand stays flat, that rate will continue to go up. Right, so that's one theory that we've got. I'm really hoping that happens. So that's dry van. Refrigerated market, very similar deal. Refrigerated, obviously reefer rates are much higher. If you're in the reefer market, I think this is going to be a really good year, largely because the non-domicile CDL, English language proficiency, disproportionately affects produce haulers, particularly off the West Coast. Right? So when produce season starts running, when they transition lettuce back to Salinas, you are going to see if there's any truth to the amount of drivers in the industry that shouldn't be here, it will manifest itself when produce starts running out of Salinas and the Central Valley, in reefers in particular, up over the Donna Pass on I-80. That's where you will see this, because that cohort of minorities dominates long-haul team produce. That's the first place we're going to see it. We already saw it in Florida with Valentine's Day, because you know what they did to every scale house in Florida in September? Turned them into immigration enforcement centres. So who wants to go to Florida? Because there's only a couple of roads in and out, right? So as soon as that happened in September, capacity tightened, fewer trucks, berry season hit, Valentine's Day hit, and rates went through the roof because there were fewer trucks than loads. Produce season's a bit slow down in Florida, but you get to Mother's Day in particular, where 90% of your flowers come in from Ecuador and Colombia into Miami, rates are going to skyrocket. Road check week, May 12 to 14, rates are going to skyrocket. Because if you've been running a shady ELD device and you've got paper logs because yours has been yanked and you've got paper logs, who wants to be out on the road during road check week when the focus is on ELDs? There's a lot of carriers that are going to be off the road that week. Reefer carriers take time off at double the rate dry van and flatbed. Why? Because they run the 150 mile air mile radius, the ag haulers exemption, and you've got to have paperwork to prove when you used it. A lot of drivers that use the ag haulers exemption don't have the right paperwork when they get inspected, so they take that time off during the week. What it means is fewer trucks on the road check week, rates are going to skyrocket. So if you're in the right place at the right time and you've got all the paperwork, it'll be a good week rate-wise. Right? So that's the theme of this year is there'll be a lot of volatility around key events. July 4, Valentine's Day, Mother's Day, road check week, spring seasonality around garden centre, filling up garden centres with mulch and things like that. That's the reefer market, sitting about 24% higher year over year. That's the seasonality. Flatbed totally different. Flatbed spot market is very different than flatbed contract. So flatbed contract, large fleet, contract loads, roofing shingles, dimension framing lumber, plasterboard. So think about that. Single family housing is depressed. The general economy is not doing well on the building side. So contract rates for flatbed carriers are dropping, because there's not enough demand. Rates for flatbed carriers in open deck are surging. So how is it the two flatbed markets can be so different? What do you think's been driving the flatbed demand in the last few years? What sector? It's not combines, it's not big tractors. What is it? No, construction, AI data centres. We've had a boom in AI data centres and diesel and natural gas power generation, big Caterpillar generators and modular frames and cooling centres. Anything to do with data centres and data centre construction has driven the flatbed spot market through the roof. If you've got open deck, because why? Data centres are where? In the middle of nowhere. And there's cranes and permits and delays and the long deadhead mileage component out because you're in the middle of nowhere. It's perfect spot market freight. If you know your stuff, open deck is a really good sector to be in right now. And that's what's been driving this market for 1.5 years. And some people have said, because the spot market flatbed rate's up, the rest of the market must be up because that's the industrial economy on the back of your flatbeds. No, data centres are up 200% since ChatGPT came along. Data centre construction. So if you're in that space, nuclear power, anything to do with power generation, nuclear power, construction, machinery involved with data centres, all that stuff, absolutely booming. And you can see here very strong seasonality. Rates are up about 12% year over year, but you can see the seasonality as rates go up to May and then they plateau and then they drop. That's a flatbed seasonality phenomenon because it's building, construction, nursery, planting season. Machinery imports are pouring into Baltimore. That's where the volume is right now because March is peak machinery import season in the Port of Baltimore. Good money to be made right there. But the market then flattens out and then starts to drop off and then picks up again in winter. So that's the seasonality, but open deck is having a wonderful year. And that's what the cycles look like. Very strong flatbed market. All right, I'm going to pause there because I think I'm out of time. Questions? I want to answer your questions if you've got any. Any questions? You must have questions.
Yep.
Shoot.
What's your base case scenario, like of the market? Like when you look at this, like kind of if you go back to the original market there, like where's your base case on kind of this? It just seems like it's just rolling.
It is. So it's going sideways. I'm going to say the market lacks direction from a demand perspective, right? But if capacity keeps exiting and the government keeps putting the foot on these people that shouldn't be here, rates will start to lift. But demand, I see demand very flat. Other than, produce season, Mother's Day, things like that, where there's a volume surge into a market, you'll see rates skyrocket but then come back down. My base case, though, demand is flat. But I think we're seeing, our forecast is for spot rates to rise about 8% by the end of the year, by next year, and contract rates up about 11%. So I think rates are going to start rising if demand stays flat and we keep getting rid of carriers that shouldn't be here. So I think my message is if you're left standing after the last 3 or 4 years, you're in a really good spot. I know it sucks because diesel's bad, but if you've weathered that storm, I think you can weather anything. Because the last 3 years have been brutal. If you're still here after 3 years, well done. Any other questions? So I'm out in the front row, black truck, DAT on the side, come by, say good day, and I'm happy to share any information. If you want to send me your email, connect with me on LinkedIn, send me your email address, I'll include you on my weekly market update. And the best way to catch us is on 11 o'clock every Monday. I've got a YouTube show called the DAT IQ Show where I do a quick 10, 15-minute summary of what we've just done today. Thank you.